are we going to have a mini crisis, or there is also a possibility that it doesn't come and the market just continues to rip higher from here? The spin that I want to put on it is why I think that perhaps the majority are underestimating how crazy the bull case could be. And I think the bull case is going to continue. I give it a 50 to 60% chance. This is why you see Trump launching meme coins. This is why you see them saying buy crypto. All these indexes are starting to tick up, but underneath you have this fundamentally weak structural element. And so you're going to have the perfect storm for All right, we are back. Macro madness. And am I about to deliver you some gold today? So a couple of times now I've received some feedback in the comments basically saying that my signal to noise ratio is amazing. So basically more signal, less noise. And that is probably the best compliment that you guys can give me. Telling me that I'm providing signal over noise is the best compliment that I can possibly receive. I know I'll never be the best presenter. I know I'll never be the best teacher. But what I aim to deliver each and every week is signal, the important signal that you need from a macro level on these weekly shows and from a micro level on the trade wrap shows. That is what I want to deliver. I want you guys to become executors. I want to light that fire, that spark, for you to go out there and become killers in this market. More than I want to entertain, more than I want to educate. That's what I want for you guys. I want to teach you to fish. And hopefully if I can leave some clues by giving you those signals, you can go and do that. There are some amazing presenters out there, right, that build their following really, really quickly. And, I'm not here to knock any of the people that I see on X, promoting treasury companies or promoting the stocks that they're investing in. They're all doing a service and they're all doing a job. And you need to look to these guys to give you the bull picture, right? You need to understand what the people that are most bullish about things that are bullish, why they're bullish about them. But you also need to learn to start to identify the contradictions in the things that people are saying, including me, right? There's going to be things that I get wrong. And that's the beautiful thing about macro. Eventually, macro humbles everyone. Trading humbles everyone. Nobody in this space is going to be right 100% of the time. It's just impossible. There's so many things that we don't see. And even when we see them, sometimes we get the timing wrong. And, in my opinion, the most important things in this game are the signal, understanding the signal and timing, right? There's no point being right if you then go and place the trade, make the trade, and your timing is wrong, because that is just as good as being wrong. Right. I have so many stories of trades that I've had on, then taken them off, and if I had just kept them on, they would have been 10 baggers. Something was missing, either the signal, either the timing, or the mental ability to suffer through the volatility or to suffer through being wrong for a portion of that time. Anyway, without further ado, I'm going to get onto it. So those of you who watched last week's episode, the episode that dropped on Saturday, it was this one here. The next 30 days could reshape global markets forever. This macro trigger could spark a shock in 30 days. And then I provided a playbook, which I will send out to you guys before this episode drops. You should receive it this week. And I look forward to your feedback on that. And I did say in that podcast that I thought this was probably 35 to 40% chance of happening. It wasn't my base case, right? Long term, I think the markets are going higher, led by gold and Bitcoin. Stocks, property, etc. will all go up on a nominal level as well, but will they outpace gold and Bitcoin? Well, I'm not sure that's true. But the thing that I'm unsure about in the short term, and this is where the timing comes into it, is are we going to have a mini crisis first, where the central banks and the governments have to come in and inject liquidity? And that crisis could last days, could last weeks. But if it does come, I think that is when you want to be looking to put long-term capital to play. But there is also a possibility that it doesn't come and the market just continues to rip higher from here. And that is the thing that I'm trying to work out at the moment. And so this week I thought what I would talk about is the bull case and why I think the bull case is the bull case. And the spin that I want to put on it is why I think that perhaps the majority are underestimating how crazy the bull case could be. I think most market participants might be underestimating the potential for this to go a lot further than what people are giving credit for. And I mean that across all assets, not any asset specifically. And I'm going to go through 6 reasons why this could potentially go further. And when I say go further, if we use COVID as a benchmark of how the markets ripped post all that stimulus, I believe that there's a chance that this market could be stronger and could run higher in percentage terms than what it did after COVID. So today I'm going to give that bull case because that's macro. The bear case, the bull case, you assign probabilities to it, and then you make your bets based on which one you think is going to occur. Or you make your bets based on which one you think is going to occur, and then if the volatility comes, you continue to add to your bets. You always have to have a plan for both scenarios, and the third scenario is if the market just stays choppy and doesn't go anywhere, and that's a killer, especially for long-term options because it eats up all the premium. All right. So what do I think the bull case is at the moment? Okay. So there's 6 things that I think that are currently in play, 6 big picture forces that are currently in play that I think could lead to this being a bigger blow off. And again, this is when I make these statements or I make these assumptions, I'm not saying categorically that I think these are going to happen, but I give it maybe a 50 to 60% chance that I give it a 50 to 60% chance that I think the bull case is going to continue. And I give it a 25 to 30% chance that this bull run could be bigger than anybody thinks. And here are the reasons why I think the bull case will continue. And then you make up your own mind if you think it's going to lead to a bigger bull run than 2021 or not. So the first thing is Wartime Playbook reloaded. Fed and Treasury merge to fund the reshore. Just like in World War II, the Fed and the Treasury are preparing to work hand in hand again. Expect rate caps, monetized debt, and balance sheet expansion to fund America's next industrial era energy, defense, and chips. So why am I saying that? Well, Kevin Warsh, who's one of the potential picks to replace Jerome Powell as the Fed chairman, has come out and basically said he's called for sweeping changes on how the central bank conducts business and suggested a policy alliance with the Treasury Department. So basically what they're saying, if you read between the lines, what they're saying is yield curve control and debt monetization, right? And if you go back and you look at the last time that occurred, it was during World War II. You can see the increase in treasury bills versus bonds. And so if you've noticed since 2022, 2023, when Janet Yellen started increasing the issuance of treasury bills, what the government is basically doing is, in simple terms, they are using short-term bonds, so 3 months, 6 months, 2-year bonds, to finance the government's debt, as opposed to what they've been doing since 2008 to 2020, where they were using 10-year bonds, so long-term bonds. And the difference between using short-term bills and long-term bills is that the buyers of the long-term bonds are usually banks and institutions who keep that money in and as reserves, sometimes even at the Fed, right? And the short-term bills are more inflationary. They are more likely purchased by hedge funds, money markets, etc. And when these people are taking out these short-term debt that are paying interest rates of 5%, right? 4 to 5%, there's more money that's instantly coming into the system through the higher interest rates. And so these bills are more inflationary. So I'm not going to go into detail because you guys need to look into this for yourself and understand it. But basically the main point is that by increasing the bill issuance like the US government is currently doing, they're moving towards a more wartime footing. And the reason that they are moving to this wartime footing, even though we're not in a war, kinetic war, is because the West is kind of in a war against the East, China and Russia. And in order for the West to reshore manufacturing, they are going to need to run things hot like they did during World War II. They're going to need to run this playbook in order to reshore, in order to fund America's next industrial era, energy, defense, and chips, right? Throw in that and the fact that China recently stopped shipping rare earths to the rest of the Western world. And the rare earth materials are the number one ingredient for most military equipment, right? And so nobody can go to kinetic war unless China supplies the rare earths, right? So the US is forced into this wartime playbook. And so that's number one, right? The second thing that I think is going to lead to this potentially being a bigger market run up than people give credit for is the new Stablecoin Genius Act and crypto bill. What is actually happening with this stablecoin bill is it is unlocking the $3.5 trillion in liquidity that's currently sitting on balance sheets. So Luke Groman says, Waller is pointing out that stablecoins can be backed by reserves at the Fed is in our view critical in light of the preceding context. It implies that up to 3.5 trillion of reserves, much of which was created via Fed QE, right, 2008, 2020, but which had heretofore been sterilized, made non-inflationary by Fed paying banks interest on those reserves, like I said before, would begin to be more easily spent into the economy by virtue of stable coins acting like digital cash, as Waller noted. This is secularly inflationary, subject to how quickly it is rolled out. We also continue to believe that the higher Bitcoin goes, the more stable coins will be created, the more T-bills stablecoin issuers would need to buy, suggesting to us that the US fiscal and debt situation have made it so the US government now sees higher Bitcoin price as a help to it. Right? So if you look here, the Bitcoin price in blue, as the Bitcoin price runs up, the amount of stable coins in usage runs up. So effectively, what Luke Groman is saying and what Christopher Waller is alluding to and not saying it out loud is that the US needs a higher Bitcoin price because the higher the Bitcoin price goes, the more demand for US stablecoins, and the more demand for US stablecoins that need to be backed one for one with US T-bills means the higher the demand for US T-bills. The higher the demand for US T-bills means the more money that the government has to fund itself in this difficult wartime. Now, why is that so important? Well, if you look at point number 3, the Bitcoin and the stable coins is a US counterstrike to China's payment power grab. So what's been happening since I think maybe 2014 is China has a digital yuan and they have WeChat, and they are using that to bypass the US dollar system, right? And so the US has been very slow to do anything about that. They've been very slow to do anything about that. They were actually doing the opposite, right? They're telling the rest of the world when they sanctioned Russia and confiscated $450 billion worth of bonds that the US, investing in the US system isn't safe, right? The US doesn't have the military power because they don't have the manufacturing capability. So the one thing that was making the US remain a hegemony was people using the SWIFT system, people using the US dollar system. And what China and Russia and all these other countries have started doing is bypassing that dollar system by using technologies like WeChat, by using technology like Bitcoin, by using gold to settle their surpluses and deficits between nations, to trade oil and energy and commodities for gold, Bitcoin, and through WeChat. And so I think this administration has cottoned on to the fact that if the share of people using the US dollar throughout the world continues to drop, US basically uses their last big, important, powerful tool. They lose it. It's gone. So what I think is going to happen, and this is what I don't think a lot of people understand yet, is that the US really wants Bitcoin and stablecoin to increase massively. And this is why you see Trump launching meme coins. This is why you see them saying buy crypto. You see his son, Eric, saying buy ETH. This is why they're saying that, because they're trying to get their population, their citizens, to jump on board this trend, because that's what's going to happen. Now, it doesn't mean things are going to keep going up in a straight line. I think all of this means there's going to be more volatility than there's ever been before. If you go back and look at gold from 1962 to 1982, when is the last time that we're under this situation where interest rates were rising and inflation became an issue, gold was the best performing asset. But while it was the best performing asset, it was also the most volatile. And so I think that's what you're seeing with crypto, and it's what you're going to see with Bitcoin and stable coins. So I think that is being largely underpriced. You should go. I haven't even watched this yet. It's an hour conversation with Governor Waller. I'm going to go out and I'm going to give it a watch. But yeah, I really think that the end game is to push Bitcoin as high as possible. Because imagine if Americans are the largest, and I'm not sure that they are, but if Americans hold more crypto than anyone else, and you got MicroStrategy, who holds 3% of all the crypto outstanding, and all the other countries hold gold, then it's in America's best interest to make the thing that inflates most the release valve, Bitcoin, over gold or anything else, because then its citizens profit from it. And something that I give a non-zero chance, and this is if we do start to get into a more totalitarian, authoritarian, socialist, communist regime, is that the government, not this administration, but in future administrations, if citizens demand it, the government could confiscate or take ownership of part of a company like MSTR. So that's a risk out into the future that I'd be considering as well, right? But everything that's happening at the moment, there needs to be a release valve. There needs to be a release valve for all this printing. And I think that it's becoming increasingly clear by all the government's actions that those release valves are going to be Bitcoin and stable coins. And if I take you back to the last episode I did, and when I got ChatGPT to create the playbook, ChatGPT itself put Bitcoin and gold as the two best assets to own long term due to everything that's happening at the moment. The fourth thing, and I won't go into detail on this one, but I'll just touch on it. The global dollar system is under pressure. The Bank of Japan just blinked. So on the 17th of July, Japan has moved to supply US dollar equity, signaling that the dollar squeeze is happening. So the USD carry trades are breaking and the system is wobbling. These are first signs of stress before broader cracks appear. This isn't a fix, it's preemptive firefighting. So what that is, in simple terms, I spoke about last week how the Bank of England is putting silent liquidity into their bond markets, and now the BOJ is putting US dollar liquidity into their markets as well, because the private sector just doesn't have the liquidity that it is needed. So these other countries are putting in all this dollar liquidity because, why? Because the Fed and Jerome Powell hasn't stepped up to do it yet, right? In the past, Jerome Powell would step up or the US Fed would step up and provide the liquidity, but they're not doing that because they're afraid of, or Jerome's afraid of inflation. And that's why you see Donald Trump basically calling for him to resign or calling for his head, because as per point one, this playbook needs yields and interest rates to be lower, because if that short-term debt is lower and not paying 5% and only paying 1 or 2%, then the US government can refund at cheaper rates. And what that's going to basically mean, if the Fed doesn't provide liquidity, or until it does, is all these other central reserves or the reserve banks are going to have to fill the gaps. So we're sitting in a situation at the moment where we're about to start growing, like the PMIs, the inflation, all these indexes are starting to tick up. So we're about to get into growth, but underneath you have this fundamentally weak structural element. So things are starting to grow and tick up. Inflation's starting to tick up. They're going to have to drop interest rates into that, and they're going to have to provide more liquidity for the system into that. And so you're going to have the perfect storm for a rip and a run up, potentially, in my opinion. And I think that's something that a lot of people might be underpricing. Another one that I saw just recently is Bitcoin social sentiment is dead. So if you look at Benjamin Crow's post, he has a program that he's built, a software that he's built, and he tracks a whole bunch of metrics. And one of the things that he tracks is social sentiment. So as what you've seen in the past is as social sentiment, and he does this through things like YouTube views on some of the biggest crypto influencers and mentions on X and things like that. So in the past, what you've seen is as the social sentiment has gone crazy, it has coincided with a Bitcoin top. So in 2017, in 2021, the social sentiment topped twice and Bitcoin topped twice. We're at all-time highs here, and the social sentiment is on the floor. What's happening now might just be institutions and smart money positioning, and the retail money still might not have come, right? And if you're watching this, we get anywhere from 500 to 2,000 views per episode. I want you to put, because you guys are probably retail like me, right? And so I want you to put into the comments, are you positioned? Are you positioned where you want to be? Are you at your max capacity at the moment, or are you still trying to get positioned? Because what this tells me is that there's still a lot of retail interest to come into these markets. And again, that is another potential wind that is going to push this bull market beyond what anyone is giving credit for at the moment. Just on that one as well, you can see that in the last 30 days, here's the top 12 crypto tokens. So Bitcoin up 14%, ETH up 55%, XRP up 66%, BNB up 17%, Sol up 31%, Doge up 67%. Yes, my little bag of Doge, the little doggy coin, is one of the top performers. ADA up 51%, Tron 16%, Hype 36%, XLM 94%, Sui 44%, and Link 54%. A lot of people are saying, or people ask, is it because retail is piling into these coins? And they're confused. Like, why are these old shit coins from previous cycles pumping? And it's because I still don't think retail's here. I still think this is like the big traders, the large money, basically shifting, rotating money from Bitcoin into ETH, into Sol, into Doge, into Sui, because the way that the big boys play is they go where the liquidity is. The big boys aren't going to go from Bitcoin to some shit meme coin with $1 million market cap. They're going to go where there's most liquidity, where they can make buys without moving the market. And then on the flip side, when they want to get out, they can get out because there's enough liquidity to get out. So the reason that these big names are pumping, these top 12 are pumping old coins from previous cycles, like Sui is the only new one here that I can, maybe Sui and Hype, the rest are old names, is because that's where the biggest market caps are. That's where the liquidity is. And that's where people are going to be able, the big money is going to be able to trade in and out. Right. So later on down the track, you're going to see all the shit coins potentially run. But that is way too late in the party. And it's probably not where I'm going to want to play with much capital. I want to have taken my chips and ran before then. So this is important to know as well. I still don't think retail has arrived. And then, I spoke briefly before about rate cuts into growth, the final catalyst and the next problem. So what all this creates, and if you probably have a situation at the moment where institutions are like, we need to be short this market. It's at all-time highs. The S&P's at all-time highs. Stocks are at all-time highs. We need to be short. So as they start to build their short positions, which is I think what they're doing, that actually sows the seeds for a potential short squeeze, and that's what causes a blow-off top. Because when these institutions have to cover their shorts or take down their shorts, they actually have to buy the underlying stock back. So then you've got retail interests, smart money interests, and you've got these institutions that have capitulated and are buying this stock back, and that's what causes the blow-off top, right? And so at about that point, when you hear that the institutions are starting to come back in and get long again, because that's how it'll be framed, the institutions are getting long again. They're not really getting long. What they're doing is basically covering their short positions and taking their short positions off because they're getting wrecked. They're not necessarily getting longer. And so when you start here, the institutions are getting long again, potentially end of this year, first half of next year, that's when everyone's going to start to think, oh, this is going to keep going. This market's going to keep going. But that's the point when it becomes most risky. That's the point when it becomes most risky because the rate cuts into growth, the shorts capitulating, the rebound, the 3.5 in potential liquidity, the refinancing of government debt, running the engine hot. That is the ignition for the next problem, which is inflation, right? And that is where we need to be cautious, right? That is where when asset prices have ripped and you start hearing people talk about, the institutions are getting long again, that's when you need to be cautious because that's when we're going to have to start dealing with the next problem, which is going to be rising inflation. And that's when you're going to want to be taking chips off the table potentially. The other thing to consider is that all of the COVID debt from 2020 is all coming due second half of this year. So there's a massive need for liquidity in order to refinance all that COVID debt. But once that refinancing is done, then the governments and the reserve banks can afford to take out liquidity or not supply it as readily as what they're supplying it at the moment or what they're going to supply it. All right. Once they've sorted their refunding needs, they can allow a little bit more market destruction to occur. So then the question in my mind becomes, does the US administration let that happen before the midterm elections in the middle of next year? Or does this party run hot all the way up until the midterms? So you've got three cases. It's like the party runs hot, that we have a mini crash now, and then it heats up again. Ironically, if we have a mini crash now, you're probably going to get even bigger blow off, or it keeps going now and stalls out until the end of the year, or Trump and the administration runs this thing hot into the midterms, and then we see. All right. Anyway, guys, I hope you found this useful. I hope there was enough signal in this. I hope the explanation was clear enough. If you do find it useful, please like and subscribe, send it to a friend, and do not forget to join the 10K challenge. I think we have something like 600 of you crazy cats that have now joined that challenge. Like this is growing momentum. It's building legs of its own. I want to see how crazy we can go with these subscriptions. So forward it out, send it through, and don't forget to ask your questions in the weekly trade update. Until then, guys, have a great week in macro, and I will see you next week.